Today's webinar is going to be on how the valuation profession has changed and evolved in the last 15 or 20 years and its adaptation to different challenges, more specifically the current COVID-19 implications. So I would like to extend a warm welcome for everyone joining us today, and I hope this webinar provides you with guidance and insights and help you in a way or another to navigate through these unusual times. So with that said, I would like to welcome our guest for this webinar, Mr. Simon Townsend, who's a fellow member of the Saudi Authority for Accredited Valuers, Taqeem, and who's also a fellow member of the Royal Institution of Chartered Surveyors. So Mr. Townsend is also the head of the CBRE Middle East, North Africa, and Turkey, as well as the general manager of the recently established CBRE business in KSA. So, Mr. Townsend, thank you for joining us today. Please go ahead and give us an overview about your experience and the roles you've taken over the years.
Thank you, yeah, and it's a pleasure to be here. Firstly, I hope you're well, your families are safe, and you're having a truly blessed Ramadan this year. So, as mentioned, I'm Simon Townsend. Good evening. I'm a fellow, as you say, of the RICS and also Taqeem. My main role at the moment is I look after the strategic advisory team for CBRE. CBRE, as you probably know, is the world's largest real estate advisory firm. I have the pleasure of having the valuation and consulting teams reporting through me, and I'm the general manager of the KSA business, the advisory business. I've been a chartered surveyor since 1996. Originally started valuing in 1992. And have been in the Middle East for about 20 years. I've previously led teams at Clutton's, investment banks, and private clients. So been with CBRE on and off for almost 15 years now. So we're excited about the kingdom. We're excited about the region. Valuation underpins pretty much everything that we do. It's taken us a long time to be registered in the kingdom. We've been working hard with the team at Taqeem, and I'd like to extend a thank you to them, obviously, for all they've done in helping us get through the regulatory process. And one of the promises we made to Sultan and the team was that we promised that we'll give back. We promised that we'll knowledge transfer and we'll help wherever we can. And hopefully this is the first of many webinars and things that we can do together between CBRE and Taqeem as we move forward.
Hopefully. Thank you so much, Mr. Townsend. So on today's webinar, we will be discussing several topics that we hope somehow gives you an idea or a better explanation that you can relate to or actually apply on your work. So, Mr. Townsend, you've mentioned that you've been taking valuations since I would say 1992. In your opinion, has the valuation profession changed since that time?
I think it's certainly evolved in a positive way, and I think when I started doing the valuations, most of what we did was textbook based. So now the valuers are relying on technology and the Argus and some of the other softwares that we use. It's fantastic. It processes and gives us some of the outputs. Historically, I sound like a dinosaur. Previously, we'd have to go to textbooks to work out discount rates. We'd have to work out yield profiles, deferred yield profiles. It was a lot more challenging. So technology is one thing that has changed, but I think the clients have changed, the market has changed, and the regulations have changed. And what I mean by that is client requirements have changed. There were less privately listed and publicly listed funds, so the requirements on valuers were really more for bank finance or for accounting purposes. With obviously what happened in the global financial crisis, regulations tightened up, requirements tightened up, and so valuers have had to go through an awful lot of change, mostly around the reports, mostly around the outputs. But one thing that hasn't changed, and it hasn't changed for a lot longer than I've been doing valuation, is the underlying fundamentals and the underlying principles. And I think valuation textbooks have probably been updated since the 1960s onwards, but the fundamentals that they contain haven't. And I think knowing the definitions of value, knowing the basis of value, and when they can be applied certainly hasn't changed, and I don't think it will continue to change as we move forward.
Yeah, exactly, and I couldn't agree more. So what about the role of valuers? Do you think it has changed and evolved over the years?
I think it has, and I think it's continuing to evolve as well, which is good. I think historically valuers were the quiet department that sat in the corner. They were processors of numbers. There was not limited client interaction. Bank sent a request, evaluation was done, sent by fax because emails weren't really working as functioning as well as they were then. But, documents were done. There wasn't much interaction. As we've moved forwards, and certainly now, I think, valuers and clients sit hand in hand. They work very closely together. I think the role of the valuer has evolved into one of being a trusted advisor rather than a service provider. And I think, a lot of valuation has provided the basis for a lot of springboards in the real estate world. So people have moved into asset management, they've moved into capital markets and things. But it's that underlying education and experience in valuation that's given them the ability to do that. So I think, the role has changed. It's become a wider role, almost a Swiss Army knife, if you were, with different services and different scopes for different clients. But certainly it continues to evolve.
Yeah, for sure. So since, laws and policies are different in every country, do you see the role of the valuer different as well? In KSA and compared to, let's say, US or the UK?
I think I'd answer that certainly with a very loud no. And that is that the basic role of the valuer, or the main principle of the valuer, is to provide an independent opinion of value for a specific purpose, whether it be accounting, bank finance, etc. That doesn't change across geographies. Hopefully, the methodologies, there may be tweaks around the edges, but the methodologies tend not to have changed across geographies. I think what does change across geographies is the way the reports are used, the way the reports are written. Obviously the measurements and the currencies and things change. I think the principles don't, but certainly and shouldn't change. The ethics and the compliance shouldn't change. But I think how the reports are used and the quality of the report and the requirements of what goes in it has certainly changed geography by geography. But what I would say is, if we compare the Kingdom and Europe, just as an example, because of the consultation that Takim has done with the RICS, with the ISBC and others around establishing the regulations, I think there are a lot of similarities in what valuation reports should say, at least from a content point of view.
So moving on to the importance of implementing, or I would say having, regulation and valuation practices. So you've covered the role of valuers in Saudi. How do you see the role of regulation in the valuation business?
Yeah, no, I think if we go back a little while, there was a lot of pressure on the government and the industry to regulate valuations, because the investment decisions were being made, banks were lending money. And there was no real common basis for those assignments for those decisions to have been made. And I think what regulation does in any market is it inspires trust, and it trust not only in the profession, trust in the outcome, and that trust hopefully extends into a better quality of compliance. And more importantly for us in the Kingdom, and I think this is, we look at the Vision 2030 and delivering the plans for the future, all of these amazing projects that we see all over the coasts, inland and others. At the end of the day, we want to bring foreign capital. We want foreign capital to participate and support the growth in the Kingdom, as well as obviously the capital from the Kingdom. And the only way we can provide the platform for foreign capital to come in is to have a trusted regulatory framework. And I think, the valuations will underpin, or be one of the key underpinners of that. So really, I think the most important thing for regulation is trust. Trust that inspires in us, trust that inspires in the market, and trust that it implies into bringing foreign investment into the market.
Yeah, for sure. So, as you know, regulation is not easily implemented, and it comes with challenges. So how would you see the challenges in progressing the role of the valuer in markets such as the Kingdom, because the Kingdom's market is regulated by the government policies, and on the other hand, other markets such as the UK, where it's regulated by the profession and the market? If you could elaborate more on that.
Yeah, certainly. I think if we look at the Kingdom, and I appreciate, it has been around for a very long time, but I think if we look at the real estate world, it certainly has gone through a significant transformation in the last few years. So it's, from a regulatory standpoint, the RICS has been around since 1881, I think, or 1880 in the UK. Certainly, Takim has grown in strength, but it hasn't been around for that long. And I think the importance of government regulation at the outset is to almost force the profession to adopt, to almost force us to adhere to rules and regulations. it gives the regulator some teeth. I think in the short term, that's important. I think as we move forward, when the regulations are established, everybody, understands them, they're sort of more progressed, then I think the government role will potentially relax a little bit. And I think the market and the government will work hand in hand, like they do in other geographies, to protect and regulate the market. But I think in the short term, to catch up, it was quite a steep curve, and it needed government intervention and government support to make that happen, I think.
Yeah, for sure. So would you say that the regulatory framework is, I would say, an inhibitor for growth?
I'm going to be unpopular and say in the short term, I think yes. But in the short term, I mean during the period of establishment and getting people on the journey, as it were. So I think, there's almost a slowdown, or there was almost a slowdown in the amount of valuations that were going out because people were adjusting, learning, adhering to the regulations. So I think in the short term, yes, it was an inhibitor to growth. But, and this is an important but, I think now that period has passed, I think it's now a facilitator of growth. Because I think now the market, for the reasons I mentioned, now there is this trust. There's this increased understanding of what valuers do. Hopefully an increased respect for the role that the valuers play in the real estate decision-making process. I do think that there will be continued growth and around that. But it's one of many factors. But I think in the short term, we have to be honest and say any change, people need to reflect on it. And I think that, we as a profession took a step back while we understood the regulations, while we changed our businesses perhaps to adjust to those regulations, to do the trainings, to do the retrainings, pass the exams. And I think that slowed things down. But now we have a sufficient number of people qualified. I think we're on a fast growth again.
Yeah. So what about the role of education in all of this?
I think, there's a reason why the RICS and Takim and others insist on people doing CPD or continuous professional development. I think education is not a one-off. We obviously have to have a uniform basis of understanding across the profession, and also not just the valuers, but also the clients and the stakeholders that benefit from valuation. So I think education is twofold: one of the practicing of valuation, and one of the beneficiaries of the valuation. And I think education is important to make sure that we do things correctly to protect all of the integrity and things that we talked about. But the continuing education is equally important. I mean, it's why we're all sort of sitting today is, to understand, to learn more, to get, to benefit from experiences that happen globally. And I think, we need to ensure that it's not just the initial value, not just the initial education that we do. And that's important, passing the exams and learning what we need to do. But just keeping that maintained, keeping that, up to date. Like a pilot has to do a certain number of hours every year, obviously, to keep his wings. For us, I think we need to do a certain number of hours of relearning just to make sure we're always at the top of our game.
Yeah, for sure. I mean, we're talking about risk here. How do you see valuers mitigating risk? And do you see, I would say, an increase in client discussing risk and reliance?
I mean, risk is it's certainly increasing. And it is a worry, particularly as a global firm. We have 100,000 people plus all over the world, working for CBRE. And if you imagine the potential risk that valuations and others could do, it's quite significant. And I think we as a profession, obviously have rules and regulations we have to follow and professional indemnity insurances that we need to have. We can mitigate and limit our risk through valuation reports, through engagement with the clients. We can never remove it entirely. And I think that's important, that people think they can just put a line in that says this valuation has no risk. There's still an implied risk with all the valuations that we do. And one of the areas that gives me a lot of concern is that, there are different risk profiles for different valuations. And if we think of a bank valuation as an example, we limit the reliance, we limit the reliability, and we limit the risk to our client, to the bank. So it's only one person that can rely on it. If there is an issue, then only that one person can take action and sue, as it were. If we then go to a stock market listing, an IPO, you have the IPO document that goes out to thousands, hundreds of thousands of unknown people, and they make an investment decision based on your valuation effectively in that were put in were offering unlimited liability without actually understanding the importance and the ramifications of that. And I think as a market, as a profession, we have to we all need fees, we all want fees, and it's important that, that we all chase the right mandates on the right basis. But I think we shouldn't disregard risk. We shouldn't, put a mandate in on the hope that, we might never get sued. We'll be okay. We have to reflect that. And unlimited liability valuations are notoriously risky. And to see them priced the same as a single valuation is, I think, damaging to the profession. So definitely risk is something that we have to be aware of. Understanding who has the right to rely on your report, who has the liability in that report. We write that in our terms of engagement in the report itself, but valuers should be really clear in terms of who they extend that to and how that report can be used.
Yeah, for sure. And I mean, as everybody knows that lacking regulation and not having unified standards or laws will eventually result in variations among these valuation practices. So just like you mentioned, I mean, the professional experience and proper education of the valuer plays actually a major role in concluding the value at the end of the day. So, I mean, it obviously is just like you mentioned. So thank you. So let's go into deep about a very crucial topic, and I think it's a question that comes to everybody's minds these days. So this pandemic is somehow affecting valuation practices. I know we say this a lot, but it sure does. It affects a lot of valuation markets across the world. So how do you see this impact on the valuation service line? And feel free to elaborate more on the short and long-term impacts.
Yeah, no, thank you. And I think the first thing I think we have to say is that it's obviously the whole world is seeing impacts across all of its services and all of its service lines. And I think one of the positives, if there was a positive in this regard, is that as a global business, what we are seeing is that different sides of the world are entering and exiting stages of this pandemic at different times. So there's a lot of lessons that we learn. We have daily, weekly calls with colleagues in Asia, with colleagues in the US, colleagues in Europe, almost lessons learned as we go through. But I think the observations that I have so far is, and I think these are, based some on my own judgment, some of what my colleagues have said, but observations nonetheless, is that I think the valuation profession out of all of the real estate service lines is possibly the one that will rebound fastest. And I say that because if we look at what's happening, there's no doubt that banks are going to have to look at the restructuring of loans. Perhaps the changes in rental values means that debt to equity covenants can't be maintained within loans, so there'll have to be financial restructuring. There may be M&A activity with distressed assets or assets that are no longer viable to an investor group. Now, for each of those, evaluation is a fundamental component of the process. And I think the other thing I would say is that if we are moving towards the end of the year without changes in what's happening, the standards in terms of accounting standards and everything else do require valuations to be done anyway. So we always have a regulatory reason why valuations are carried out. So I think I look at our colleagues in Asia. Their views are that actually their valuation volume hasn't changed. In some markets, it's actually increased, and the reason it's increased is it's the same clients, but the frequency of valuation has gone up. They've asked for valuations, monthly or quarterly rather than yearly, so they can keep live tracking their values. I think people are obviously seeing risk in the market, and I think people are wanting to be aware of what is the impact of this to me as we move towards the year, so that they know what they're going to have to do from an accounting point of view at the end of the year. But I think one of the areas where valuation is benefiting at the moment is that a lot of landlords, genuine landlords, are looking at how they can work with their tenants through this period, whether it's giving rental concessions, whether it's, changing lease terms and everything else. And the key for them is how do they do that with least impact on the capital value of their asset? And that's where sitting with the valuers, and we're spending a lot of time doing this, sitting with clients who say, I want to give this tenant 3 months rent free, as an example. What would be the impact on value if I do that? And what can I do around the lease structure or others to mitigate that value at least from a technical standpoint, or from a sort of valuation theoretical standpoint? So then the valuer takes a different role. It moves, you asked how I thought the valuer was evolving. It moves then into an advisory role where it sits, uses the valuation skills and underpins what's going forward. So I think valuers should be aware of what's happening around them. I think everybody is, but I think the most important thing is they should be a little bit calmer than perhaps some of the colleagues in the brokerage world and others where, those markets may take a little bit longer to come back.
Yeah, for sure. So as a market practitioner, how would you adjust your business practices to undertake valuations?
I think it's certainly been a challenge, and I think the comments I've made earlier about engaging with the clients and agreeing the terms with the clients. I think depending on which geography you're in and globally, I think certain lockdown provisions have prevented physical inspections. And in a lot of instances, optionally people don't, choose not to do inspections. So I think one of the things that the team have done is, and I hadn't thought of this, the team have had Zoom inspections, where if we think of commercial buildings, most of them have a watchman, a security, a physical presence that's at the building all the time. So under guidance, they've done an inspection via Zoom, or what your Teams call or whatever these things are, wherein the guy's been navigated around the building and they've done the inspection that way. So I think, the way we inspect buildings has changed, but the most important thing that we've changed and has changed is the terminology that's used in the reports. So I think, no matter how we dress it up, we are in a period of market uncertainty. There is a lot of concern around the market, a lot of concern about, the integrity of the values. So the wording in the reports has been adjusted to include the market uncertainty clauses to be a little bit clearer, not that it shouldn't have been, but to be a little bit clearer on what assumptions have been made, what assumptions the client has given, and so on and so forth. So I think there's a lot more compliance and risk checking because of the concerns about the potential volatility of the market.
Yeah, I see. So during these periods of I would say, market challenges, what sectors do you think are the most impacted? From a valuation standpoint.
Yeah, I think, obviously the valuation world is driven by the income. The majority of it is driven by the income that an asset generates. So I think, the assets that, and we know this from our daily lives, and we look around us, the assets that have seen an awful lot of impact are the operational assets, the hotels, the F&Bs, the retail, and so on and so forth. And obviously, a lot of the revenue that's generated through those is not fixed. It's variable in terms of the percentage of turnovers or percentage of bed nights or whatever the ratios might be. So I do think the operational real estate there will be one of the hardest hit from a valuation standpoint in a negative way. I think the development projects, when we look at development valuations, obviously the time changes in delivering valuations, the potential construction cost increases, challenges in getting goods into the country through closure supports and others. They'll obviously have an impact on construction costs, which will have an impact on the underlying development value. I think when we look at the other asset classes, again, we go back to the fundamentals of valuation and looking at a willing buyer and a willing seller. Who are the willing buyers and how are they pricing? How are they pricing assets at the moment? I think all the sectors probably will be affected, but I certainly think the operational ones will be affected most.
Yeah, for sure. So we've been receiving a lot of questions from the audience, and I would just like to note that we're gonna get to them at the end of the webinar. So a very important question that comes to mind is, what can a valuer do to, I would say, ensure reports and opinions are actually reflective of these periods?
Yeah, I think, I think the RICS and ISVC have issued guidelines around the use of the market uncertainty clause. At the end of the day, the valuation is a snapshot in time. It's an opinion at a given date with the parameters and the available information. I think the key thing that a valuer can do is to say over-specify all of the information that's used for the valuation, all of the assumptions, the key assumptions, where the data has come from. Because I think the markets everything is changing so quickly at the moment. The key is the key way really is just to ensure that all of the assumptions and everything is listed clearly, so that anybody that picks up the report can see how the number was, derived, what opinions were made, and how those opinions reflect the market as at that day. But I think it is moving so fast. Also, the lack of transactions happening at the moment, whether that's because they're unable to be registered, whether that's because bank finance is pending until the bank's fully open. But I think, whatever comparables are used, whatever transaction data is used, that should be cited and adjusted, and the adjustments explained in the report.
Yeah, I mean, these times definitely gives us a lesson that we could all learn from somehow, and I think we all should come together and support each other in these unusual times.
And I think that's an important point. I think one of the areas that we haven't done particularly well as a profession, it happens, in Europe a lot, it happens in the US a lot, is our data is important to us, and because there's not a public data source, data is quite privileged. But I do think as a profession, there's a lot more we could do collectively in terms of, sharing thoughts, sharing data, sharing ideas, because, we don't want to have three different valuers with three completely different views of the market. Everybody's view is valid, and I think it's important. The more that we speak, the more that we share ideas around this, the wider the commonality of views will become. And, it certainly gives us a lot more strength when we all fight as a profession.
Yes, for sure. So when it comes to the future of valuations, you've mentioned valuation changes that you've seen in the almost 30 years that you've undertaken valuations. So do you see technology playing a stronger impact in the future?
I do, yeah, and I'm not necessarily one that embraces technology perhaps as much as some of the other valuers, particularly the younger valuers. But I do think that technology has played a part as we've moved forwards, and I think it will continue to play a part. And I think, if we look at not necessarily the physical undertaking of valuations, but the technology advances around the edges, the data analytics, and some of the data processes that happen. I mean, there's an awful lot of things, very clever things that people are doing with the data that valuations have. And, for instance, our colleagues in Spain did a presentation recently where they could, just with taking one house in Spain, you pick a house, they take one asset, they will tell you how that value would have differed had it been close to a school. What happens if the school closes down? What happens if the shopping centre changes to an upmarket? What happens if the shopping centre is replaced by industrial estate or something like that? They do that in seconds, and it's literally the algorithms behind taking all the data from the public sources, showing how values differ depending on the locations that it sits in or changes to those locations. That's something as valuers that it would take us a little bit longer and be difficult to articulate. So I think the data analytics behind the edges is certainly changing the way that real estate professionals and valuers report. Certainly, it's very helpful, and I think clients will certainly take advantage of that.
Yeah, for sure. And I mean, we see and read a lot about the automated valuation models, the AVMs. A lot of people think that they're becoming the new trend along with other technological developments. So the question is, do you think we see technology as a threat here, or should we embrace the side?
Yeah, no, I think both. To be honest, I think it's the threat and a sort of an enabler. I think I'll start with the positive in terms of enabler. I think it is going to give valuers more tools, more power as we go forwards to provide not only just a valuation, but the opinions and the support of what to do next. Here's your value, but this is what you do to change this, this, and this. I do think it will help with that. So I think there is a positive in terms of the threat. And I'm going to upset all of the residential valuers, but I think the residential market in particular is one where the AVM is going to cause future threats. I think if we look at Europe, we look at Australia, in our business in both, they do significant volumes of automated valuations per day. These things are done in less than a minute, from instructions output into the report. And I think when we look at the available clean, transparent data sources, whether it's governments, whether it's, home societies or, valuers, everybody uploads their data. So I think the automated model works then. I think in a market like ours where there isn't those data points, we don't share. I think there's a little while longer yet before AVMs take our jobs. But I do think as we go forwards, the residential sector will be one that certainly, the number of values in that space will decline.
Yeah, for sure. I mean, at the end of the day, people should use this technology on their side and not feel threatened by it. So when it comes to valuers and the valuation business, how do you think they're adjusting to the role of technology?
I think valuers and clients are both adjusting, and I think valuations historically have been paper. There's been a big, thick report that's landed on somebody's desk, a number at the back. What we're seeing is most electronic now. They go between the valuer and the client's portal. They filter into an asset management portal, and that enables them to do some asset value projections across their fund or across their portfolios. The technology is linking the valuation output to the rest of the real estate cycle, and I think that's important from an asset management, an investment basis, to be able to see the different scenarios, taking a valuation as a base point. So I think there are ways that it's going to support and help as we go forward. It certainly is starting to help with inspections, and it's making us as a valuer, it's making the time we physically have to write things and do things. It's taking that, it's reducing that. There's apps, and whether they're owned by the likes of ourselves, whether they're publicly available apps, that you do your inspection notes and it instantly filters into the model, instantly goes into the report. The photographs appear, the valuation software takes the outputs and merges them into the report. It just speeds everything up and makes everything more efficient. So I think we still need the humans to check it. We still need the humans to make sure the inputs are right and in the right place. But I do think, technology is making our life quicker, smoother, but there's more demand on us to make sure we know how to use it.
So have you used these tools, or tried to try them on? Or
the automated valuation one, I've played with the model in Spain, and CBRE Spain has spent a lot of time doing that. And it's a great tool, but it crumbles if you go outside of, you go to a market where there isn't a lot of data. But you don't have to be that flash in the residential space. And I'll give you an example. In the UK, there's a website, I think it's called Zoopla or something like that, where it basically a house selling website. But you can type an address in there and it will pull up details of that house, how much that house previously sold for, what its current electricity bill roughly would be. And it also tells you what the house next door sold for and the one across the road sold for. So actually, as a residential valuer, you don't need the automated valuation really to do that. You can just use some of the public sources. But the automated tools, the output is fantastic, and it really is. Some of the analytics that it does is great, but I think I still prefer pen, paper, calculator, and laptop. It's still a little bit technical for me.
So I would like to address a final question before we get to the other topics and other questions. So what do you see as the most important characteristics required for a valuer in the current market? And what do you see for the future of the profession in general? And please feel free to elaborate more on this.
For sure. I think one things I've learned is valuers have to be, number one, they have to be human, in that there's a lot of involvement and interaction with clients, and they're not always easy involvements and interactions. Particularly, real estate it becomes personal to a lot of people, particularly developers who built something or investors who bought something. And I think, sometimes you go to the doctor and you get bad news. Sometimes you go to a valuer and you get bad news. It's how you give that bad news, and more importantly, how you give a solution to the bad news. Your building is only worth 10, but if you do X, Y, and Z, your building technically would be worth 12 or 13. So I think a human element is important to a valuer. Adaptability is important. Markets change, very, very frequently. So a valuer needs to adapt to the markets. He needs to be able to absorb all the market data, keep abreast of the market data, be willing to learn and challenged on a regular basis. Ethics is important in terms of, as I say, the client wants a value of 12. you have a choice. You either give him the value independently or you give him the value of 12. I think those that just knee-jerk and give the value of 12 are probably not the best people to be long-term valuers. So I think there's a lot of things around that that are key characteristics. In terms of the future role of a valuer, I think valuers are evolving, as I said earlier, into an advisor. I think that's going to be key. When I look at any decision around real estate, and again, every occupier, every investor in some form or the other touches real estate. Every corporate has an office, has a lease, and I think the role of the valuer is evolving into an advisor. It's not just the value of your building is 12. Moving to the next one, it is, how do you maintain the value? How do you mitigate the risk of that value? How do you enhance that value? It's evolving into an advisory role with asset management, and some of the strategic advisory functions that go with that. So I think the future role of the valuer is not just going to be number giving. I think it's the everything around the edge that's going to evolve as well.
Yeah. So from your personal experience, Mr. Townsend, what factors valuers should consider? I mean, in terms of using technology or taking on different roles in their profession.
I think it depends on the suitability of them to that profession. And again, I have a lot of discussions when I speak at some of the universities to the students who are going through. Their first question usually is, which side of the valuation profession shall I will get me most paid, or will grow my career quickest? I think valuers should certainly have an underlying basis in as many asset classes as they can. I think technology and embracing technology is going to be important, but I think focusing on one sector, particularly, let's take the specialist assets as an example. I mean, there are not as many specialist asset valuers as there are commercial valuers or residential valuers, and I think that's an area where people can focus. Plant and machinery valuation, insurance valuations, these are quite specialist. They require an underlying a basic underlying understanding of the valuation process, but they also put you in a different market. They put you in a place where you're not competing with as many people. So I do think there will be a growth in those sectors, and I think perhaps not if everybody listens and everybody jumps to that sector, but I do think there will be a growth in that, and I think technology advances, changes in education and structures certainly will be one of the areas where that moves forward.
Yeah, I couldn't agree more. And so just before we move on to the questions, just to conclude, what advice would you give to valuers who recently start their careers in valuation, namely?
I think you have to be prepared to get it wrong. And I think, and hopefully you're in a structure where, there's peer reviews, there's a lot of support, there's a lot of mentoring that happens, and obviously you don't get it wrong so that it goes to the client, but you get it wrong internally. I think there are lots of assumptions that people make in valuations. There's not always 100% right answer. If you ask 3 valuers who've all been practicing for 30 years the same question, you'll probably get a variance that's plus or minus maybe 5%, maybe not much more than that. But I think a valuer has to be prepared to get it wrong and learn from that. Learn what differences the assumptions make. Learn why this goes there and that goes there, and I think some of the things that valuers don't do is they don't challenge. The client gives them a cash flow and says it's okay, all of the tenants are going to renew, don't worry. They have to come out of their comfort zone and challenge the assumptions and question pretty much every input that goes into a model. So I think don't be timid if you're starting out in your career. Be quite vocal. Be prepared to get it wrong. Don't be downhearted when you get it wrong. Learn from that. And I think the most important thing is make sure you have the right mentor and the right support network, because I think everybody's ideas and everybody's views around the valuation process is important, because a collective discussion rather than a single number certainly helps get some clarity on the position.
Yeah, for sure. Thank you. So if you allow me, I would like to explore and let you answer some of the questions we received. We've got quite a lot of questions. So one of the questions we have for today is, in times like these, I mean, witnessing major events and dealing with challenges, obviously it reflects on market demand. How should valuers deal with uncertainties and situations like this? And would you consider the whole COVID-19 and this pandemic a threat or an opportunity? I mean, this is, I would say, a concern for a lot of valuers operating in the market today.
Yeah. I think, as I sort of touched on earlier, I think the most important thing to protect the valuation and the valuer is certainly in the report, to make sure all of the assumptions, all of the data is listed, all of the processes are listed, the uncertainty clauses are in, which basically, discloses that whilst the value is done, the markets are moving and the markets are so volatile that, the valuation there's an element of risk in terms of any reliance on that valuation. So I think that's important to do that. And I think, nobody can protect themselves more than that. Make sure the terms of engagements are clear, make sure the report is processed clear, and that the information given is all supported. And I think that's the best a valuer can do in terms of protecting themselves. In terms of whether it's a threat or an opportunity, I kind of think it's both, to be honest. I think it's a threat effectively to capital values. It's a threat to people's integrity. And what I mean there is that when values, as we talked about earlier, when values go down, clients are potentially going to have to make difficult decisions. Maybe with the banks, maybe if the loan to value covenant changes, they have to put some of their own equity in, and maybe they don't want to do that. So I think valuers will come under a lot of pressure to bridge gaps in value between perhaps where the market value is and where the market value was. So I think that's going to be a threat. In terms of opportunities, I do think there are opportunities. I think that there will be M&A activity, there will be a lot of bank restructuring. So I think valuers have an opportunity to align themselves with such clients. I think it's an opportunity when the market is difficult for the regulators to use the time to explain the basis of regulation, explain the importance of regulation, and continue that education process. But I think at the moment, I think the biggest challenge is working out what the world is going to look like when we evolve, and more importantly, how do we adapt our businesses to take advantage of that? And I think that's where the opportunity is as a profession, is for us to speak more, is to share ideas, to share concerns, to learn from ourselves and firms like us that have offices all over the world. How have they done it in China? How what's going on in Singapore? What's happening in Europe? Because the lessons that we learn there, particularly from application onto valuation, will be applicable here as we reach that point in the release or growth in the pandemic. So for us, I think it's important that we keep an eye on the rest of the world, and we adapt accordingly.
Yeah, for sure. So since we're on the same topic, I mean, what lessons, just like you mentioned, what lessons that valuers should learn from, in different experiences around the world from the current situation?
I think it's a little soon, I have to be honest, because people are still sort of working through valuations. I think from my point of view, I think one of the key lessons is the discussions, the ongoing discussions with clients, banks, and others. Because I think we all see the market from where we sit, but I think we have to remember that banks see the market from a slightly different side. They have access to different data points. They see things that that we in the market may not see. So I think one of the key lessons learned is the dialogue, and I think Zoom and all of these cool digital calls and video calls that we all use now. I think 3 months ago, if you'd have said that we'd be conducting 90% of our business by video call, we probably would have laughed. We probably would have said, no, it's important to be face to face. Our clients won't engage with us. I actually think the inverse is happening, and I think perhaps the meetings are shorter. If we had a meeting in an office together, we'd be, to talk about everything and then have 45-minute meeting. I think on a Zoom call, people get straight down to business. There's a 30-minute meeting, very focused, and I think we achieve a lot. So I think from a productive point of view, the way our businesses are changed isn't wholly bad. I just think we do have to spend more time, engage with our clients, engage with the different stakeholders. And if we understand each other and we both share our views and our concerns, then when the reports are provided to the client and there is the adjustment, the downward adjustment, the upward adjustment, whatever adjustment is given in the reports, at least the client is aware and prepared for that and has taken steps to be ready.
Yeah, for sure. So one of the questions we received is, how do we manage situations of conflict of interests?
I mean, that happens a lot in the region. It happens a lot globally. But I think if we look at the requirements, the regulations that the RICS and Takim and others put in, I mean, I think if we go back to the very beginning of the process, and I think before any job is undertaken, and I'll give you the CBRE approach, and hopefully it's similar to most of what you all do. But from our point of view, before we undertake any job, we do an internal conflict of interest check. We make sure that we're not acting for the client somewhere in the business, not necessarily the valuation team, the client, the asset, perhaps any of the tenants or any of the parameters around that. So we find out first whether we're conflicted before we engage. I think there are mechanisms where conflicts can be managed, different teams and data stored in different places and all of the other, the requirements that both the RICS and others put in. What I would say though is I think, for us, if we're aware of a conflict, the first thing we are compelled to do is notify both sides about that conflict and ask whether they are prepared and willing for us to proceed and the basis upon which we'll proceed. From a risk point of view, sometimes we declare a conflict and we suggest that we're not the right people to do that. So I think managing conflicts is important, and as the markets change and people do fight for fees, I am concerned that people may drop, as I said earlier, some of their regulatory and their compliance adherence. But I think conflict of interest is one of the biggest concerns that we as a profession have, and I think a lot of people are aware of it, and hopefully clients and sort of valuers are playing by the rules in that one.
And actually, if I may add, cases of conflict of interest are actually mentioned in the Code of Ethics and Professional Conduct that Takim issued a couple of years ago, and it's actually accessible on the website. So moving on, what's the impact of implementing the International Valuation Standards, or the IVS, as we all know, when it comes to market regulation?
I think the important thing with Takim, and we'll talk about the Kingdom, I think one of the important things there is that as the regulations were drafted, there were various professional working groups, and engagement with the RICS, the ISVC, and all of the others. And I had the pleasure of being part of some of those working groups. And I think that the important thing is the regulations that are in play that affect us all in the Kingdom do actually reflect a lot of the requirements and the regulations that are, international. So I think from a Kingdom point of view, it's quite easy to adapt. And the importance of having those and adhering to those is, and I touched very early on about, one of the things we want to do is bring foreign capital and foreign investment into a market. And I think, adhering to international standards that, the main investment funds in the US or the main investment funds in Asia or Europe, they're aware of. They know all their valuations are done on that basis. To comply with those, certainly removes one risk from the equation. And valuations should almost be delivered a little bit like McDonald's chips. It doesn't matter where you go in the world, the chips are all in exactly the same chip packet. People come to expect what's inside that chip packet. So for valuations, if they're all delivered in accordance with the same regulations, they should be pretty similar.
Yeah, for sure. So, having different standards and regulations around the world, how does this affect the role of the valuer who, I would say, deliver his or her work internationally?
I think as an international valuer, you have to have your number one. For us, as an example, we're governed by, we're an RICS regulated company. So as well as individuals, so of the geography, it always complies to the RICS regulation. So again, we have to have that in our mind. But I think one of the most important things is any valuer, wherever they go, has to be aware of the local standards. If those local standards are conflicting with the international standards, then I think we have to be very careful, because it may breach our professional indemnity insurance. It may mean that we invalidate some of the warranties that we can give. So it's important to understand the local regulations. And in some instances, there are markets that perhaps international valuers can't transact in or can't be involved in. And, as an example, certain regulations in Egypt require valuations to only be done by engineers certified by the Egyptian court. Now, as a business, we don't have that individual. There are other valuations where they don't require that, and they require certain other standards which we do have. So I think it's important for the valuer to know what the local regulations are and whether they're at odds with the international standards or comply with them.
Yeah, I couldn't agree more, actually. So another question is, what's the best way to deal with risks associated with valuing properties in the current situation?
I think, I think the disclosure to the client is important. Understanding the basis of valuation, the purpose of valuation, and being just very clear about, the process that you've gone through, the data that has been relied upon, the benchmarks used, and important again, and I know I've stressed this a lot, but important again to include the market uncertainty provisions, just so the client themselves is aware that, the valuation is subject to an uncertain market and therefore carries in itself an increased risk. So I think again, it's stuff that we're all doing. It's stuff that Takeem advises us to do. The other regulators, globally advise us to do. But I think we just tighten up in terms of the information we give, so that nobody can, or everybody, any reader of a report, can understand the risks that were in the market at that time and the assumptions that were made and the processes that were followed.
Yeah, for sure. So the last question we have is, how do you see the future of the valuation profession in light of the technological developments that we just discussed and the technological developments we see nowadays, actually?
I think the future of the valuation profession, I think it's going to grow. It's certainly something that as a business we have great plans to expand. I have a number of desks in the kingdom that I'm looking to fill in, a number of desks across the region that we're looking for valuers to grow into. And I think we wouldn't expand in that space if we thought it was a declining business. I think the role that technology plays, unfortunately for us in the region, I think we're a little bit behind because of the data that I mentioned and the access to that data. So I think we've got a little bit of catching up to do. But I think when the public data sources are there, when the clean data is available to the market, I think that technology is gonna really change the way that we do things here. The analytics that I mentioned, the projections of or the scenario analysis and everything else, it's going to make some of the advice we give, it's going to make it world class, not and it's going to really move it up a notch and add value to investors, stakeholders, and others. But I think as we don't be disheartened. I think there's definitely a future for valuers, and I think it's testament to the regulations that have happened, the number of people that have grown into the valuation role. We wouldn't be, as a business, we wouldn't commit to growth if we didn't think there was a future, and it is to be 2020 was to be for us one of the biggest growth areas in valuation. I think it's been hit a little bit. So let's say 21. Will be for us one of the biggest growth areas in our valuation business, certainly in the region and potentially across the wider part of the world.
Yeah, for sure. So we've got an important question here that I would like to conclude with. How do I become an accredited valuer in Saudi? So if you allow me, Mr. Townsend, I would go ahead and answer this question. So depending on the valuation sector that you wish to practice in, whether it's real estate, business, valuation, or machinery and equipment, or it's vehicle damage assessment, there are different requirements that you need to satisfy. For example, a college degree and specific majors or a previous experience. So once you check all of that, you can go ahead and register for the available courses that we have, that we actually conduct throughout the year. And after each course, there should be an exam that you have to pass in order to complete the training path of the sector. So along with the required education for each sector, you're required to obtain, and I mean, this happens in a lot of VPOs around the world. You have to obtain a number of experience hours, and then you can apply for the membership. And once you complete all of these requirements, you can move forward and submit the request for the practicing license. So again, all of these requirements and training path are different among the valuation sector that you wish to practice in. And as for the memberships, Taqeem has a mutual designation with international organizations such as the American Society of Appraisers, the RICS, as well as the TFA charter holders, so they can apply for Taqeem's membership in real estate and business valuation. And I think this is all we have for today's questions. We've come to the end of today's webinar, and I would like to thank you, Mr. Townsend, for joining us today. I hope the information you shared with us help valuers working around the world to navigate through these unusual times. So if you have anything to add.
In advance, Eid Mubarak to everybody, and hopefully you continue as valuers, and we have a lot more interactions locally, regionally, and globally as we move forward. So thank you all for your time.
Thank you so much, and I also would like to thank everyone who attended this webinar and send in their questions. And I hope we see you soon. Take care.
Thank you.